some of you may know, we've been running this program at Ignition for a couple of years now. It is our General Counsel Know-How program. It's training that we were offering to our internal lawyers, and then we started to invite a few GCs that we knew to come along, and then the invite list expanded, and now we have a program that runs for the year, and it covers a multitude of topics. The idea is that they're legally based topics. The next one is on the 19th of November. It's a guide to share options and growth shares. So if that's of interest, then keep an eye out on LinkedIn. You can sign up through LinkedIn or Eventbrite. And we're actually meeting later on today to plan the sessions for next year. So if you can think of any suggested topics, let us know. As I mentioned, the idea is that the sessions are collaborative. So let us know, or let people know if you've got any questions or points of view. Today we've got Philip and Simon from Evelyn Partners who are going to talk to us about transfer pricing. What is it? How to keep within the rules, the changing landscape, that sort of thing. So I'll hand over to them.
Thank you very much, Tammy, and it's a pleasure to join you all. It's pertinent that we'll be doing this in front of a legal audience because transfer pricing fundamentally is a matter of law. So we're going to be talking about what transfer pricing is, why you need to apply it, which is obviously because it's a matter of law, and taxation law for that matter, and how you're doing it. Just a little bit about Evelyn Partners. We used to be called Smith & Williamson, but we've been around for circa 200 years in one guise or another, and we're about the fifth or sixth, depending on how you measure it, largest advisor or consultancy firm in the UK when it comes to taxation matters. And I think we have a nice little niche because we're big enough to matter and have a voice heard, but we're also small enough to care and do really interesting bits of work, which has led to us collaborating with Ignition, because they obviously work with SMEs and all sorts of different size firms and go on that growth journey. And it's something which I very much enjoy myself. And so my background is I've worked in transfer pricing, I always say euphemistically, for the best part of a lifetime, for the entire 21st century. And I started off in a small and medium-sized enterprise, which is why I'm still very interested in doing it and working on that. But we obviously work on all sorts of size clients before moving over to banking, which doing transfer pricing there quite merrily until the spoiler event of Brexit somewhat came along. And then one of my more interesting but less wise life decisions, I moved to a well-known Chinese tech company and did their transfer pricing for a few years, crisscrossing Africa, until I thought a nice quiet job in advisory would do me well. So I crossed over to what I euphemistically call the dark side of advisory, having done it in-house for most of my life. So my approach is very practical for transfer pricing, having it needed to be so within industry. I'm really pleased to say I'm joined by Simon today. Simon's background is that he used to work for the Australian Taxation Office, and he joined us earlier this year. So he's got a really, really great background in terms of he knows how to deal with the regulators. He's dealt with every single one of them, including HMRC. So we're very lucky to have him join the team. So what we're going to be covering today is a few pointers. The first is what is transfer pricing, and why it matters for SMEs and firms of all sizes for that matter, which Simon's going to be taking care of in a moment. It's still the most common question we get asked, like, what is it? And it's perfectly fair, because if you're not not doing it day in, day out, it's something that somewhat goes in a box and isn't worried about until it becomes a problem, which is obviously what we're going to discuss, in ways we can mitigate any risk and front load that. Then we're going to talk about how we deal with the transfer pricing and try and keep it proportionate. And finally, we should have time for some questions at the end. So with that, I'll hand over to my esteemed colleague, Simon, who will take us through the what is transfer pricing. So over to you, Si.
Thanks, Phil. Thanks for that glowing introduction as well. Appreciate it. Before we did start, I just wanted to get a gauge of the audience we have today. So Has anyone in the audience ever, dealt with transfer pricing in your day-to-day jobs as lawyers or anything? If not, I'm happy to kick on. So basically, what is transfer pricing? So transfer pricing, it's the price at which a legal entity transfers either physical goods, intangible property or services, including financing arrangements to associated entities. And we'll go through in a bit more detail those different types of transactions that are within transfer pricing. But it's basically the price of a transfer in value between a legal entity and an associated party. So these transactions must take place at an arm's length price. So this means either the same price should be charged intra-group for these associated transactions as it should be charged between unconnected third parties. And just for some reference, so transactions between unconnected parties are often referred to as uncontrolled transactions, and then transactions between associated entities are often referred to as controlled transactions. So there are a number of ways to determine how a controlled transaction should be priced, and this obviously informs policy decision making. So some of the relevant transactions that we see in TP, and we'll also go into what an associated enterprise actually is. So an associated enterprise is a company that's within the same group as another legal entity. So it's greater than 50% shareholding. An associated enterprise is also where there's a common ownership and control. So that's where we will have 25% or more ultimate beneficial ownership in common between the associated enterprises. It's also within HMRC legislation. So there's transactions caught up by the acting together rules. So this is circumstances which enable transactions to be made other than on an arm's length basis, basically. But it's so the rules are there to basically apply to any shareholders or common ownership, just to blanket all of it. And it's also important to note that associated enterprises can be both UK to UK and UK to overseas. Although transfer pricing, typically the higher the risk there is around international cross-border transactions due to the difference in the tax regulations between the jurisdictions. So domestic transactions, UK to UK, typically is not seen as big as a risk, but it still does apply. So next is the correct transfer pricing. So it should be employed by entities of all sizes, but the UK transfer pricing provisions apply directly to large companies. So these large companies can be defined as companies with greater than 250 employees and revenue greater than 50 million euros and total assets greater than 43 million euros. Euros is still there because it is a bit dated because it is made before Brexit, so that's why it's in euros and not pounds. Some of the relevant transactions that we look at. So some of these includes on the right there. So we have typically any transfer of goods and services. If there's a transfer of any intra-group central services, so this often includes, any admin or general services. So back office management can include finance, accounting, internal audit, all of those basically central back office functions. Also the transfer of specialist services. So this is typically a bit more high value adding. So this will be research and development functions, technical engineering advice, anything like that. Also streams down to the transfer of any types of loans. So loans, guarantees, or any other financial interactions. The transfer of intangibles. So the right to intellectual or intangible property. So this can include sharing another associated party's trademark, being able to sub-license their software using their brand name, any of the transfers within those, and then business restructuring. So if there's any change in business restructuring that impacts transfer pricing, then it's important to look at. So next is the question, why it matters for SMEs. So basically small, medium, emerging enterprises. So UK corporation tax says that companies may be able to attempt to shift profits to low tax jurisdictions via these intercompany transactions and on a non-arm's length basis. So within UK corporation tax, a company which gains a UK tax advantage by way of a non-arm's length transaction is required to adjust its CT, corporate tax self-assessment, by restating the profits based on what should be happening on an arm's length basis and an arm's length price. So in addition, so the transfer pricing provisions will also apply before any corporate interest restrictions, diverted profits tax and hybrid mismatch rules as well. So next thing we go to look at for SME, so it's transfer pricing reporting. So multinational enterprises with global revenues of greater than 750 million euros must keep what we call the two basically important documents. So the first one is a master file. So this contains an overview of the group's business, nature of their global operations, overall transfer pricing policies, and the global allocation of income and economic activity. So this is one file that is basically a blanket over the whole group and across all jurisdictions. And then we have a local file. So this is specific to a jurisdiction and will only concern material transactions and supporting transfer analysis within that jurisdiction. And then obviously, which is critical, is the support for how these transactions have been priced at an arm's length price. So both of these documents, which is very important, must be in a prescribed and standardized format. And this format is set out by the Organisation for Economic Cooperation and Development, so the OECD, and their transfer pricing guidelines. So why does it matter? So what is an SME for transfer pricing? So a small enterprise is a group which has a global headcount of less than 50 employees and assets or revenue of less than 10 million euros. A medium enterprise is a group which has a global headcount of less than 250 or assets of less than 43 million or annual revenue of less than 50 million. So this is important because there is a so-called exemption, which we've identified there as a false friend of sorts. So since 2004, there's been the so-called SME exemption. So this is whereby UK firms classified as SMEs do not always need to apply the transfer pricing rules. So the background of this was that it was an EU-wide initiative with the goal of corporate tax rate harmonisation. This didn't occur, and thus every European and any ex-European nations which enshrined this in local legislation have slowly started unwounding the exemption. So specifically to the UK, this looks like HMRC unilaterally applying transfer pricing rules to medium entities. So basically effectively ending the medium exemption and basically saying that these medium enterprises should be using these transfer pricing guidelines and provisions. Also, it's for certain jurisdictions such as Jersey and Bulgaria. Their transfer pricing provisions deemed to bring all SMEs within scope. And there are also some exemptions based on certain sectors. So, for instance, there'll be some special treatment with the technology sector within these. Lastly, so the SME rules are not bilateral. So there's no SME exemption that applies in the US. So a US adjustment would be required and would need to be matched by the UK, even if an SME is exempt within the UK. It's classified as a small enterprise and could be exempt. And lastly so proving transfer pricing is part of the SAO, so the Senior Accounting Officer process. So a key risk person rules. So it has no threshold. So it'll always be covered within the scope of that as well. So I'll just now hand over to Phil to talk about some mitigation risks. Did anyone have any questions before we cross over? If not, all yours, Phil.
All right, excellent. Well, there's big opportunities for questions at the end. So thank you very much, Simon. So we're going to talk about how you can mitigate transfer pricing risk. Effectively, the key is kind of documentation and writing it down. So effectively having a robust policy. It's because it's real-time transfer pricing. You have to have a policy that's in effect now. You can't go back and say, actually, we should have done this X number of years ago, because then you find yourself in all sorts of penalty positions. And as well as having the transfer pricing documentation, you generally need an intercompany legal agreement, which actually says this applies. It's an intercompany contract. It's as if it was between two third parties, and that's seen by HMRC and other tax authorities absolutely key to it being on an arm's length basis. A transfer pricing policy doc, which may come in all shapes and sizes, as we'll discuss as we go forward, is effectively forward-looking. It's saying this is the state of our group now, and this is how things are going to be, and the policies we think are effective now. And that's very important to have on file. It's actually a legal requirement. But as I say, proportionality does come into it. And then, as Simon says, for the larger revenue groups, over 750 million euros globally, what you have is your local file, which is again backward looking, what transactions have happened in the year that's just gone in my corporate tax return, and your master file, which is a kind of group document that it's the same for every single country. You just have one per group, but the local files, you have an individual one per individual group. The other thing that people often don't think about is intercompany financing. So there's been some very high-profile cases. I think there was the Chevron case a number of years ago in the US, where the US company borrowed at a low rate of interest and recharged the Australian subsidiary and an obscene rate of interest, and it was seen as profit shifting. And the Australian tax authority, in a case very close to Simon's heart, no doubt, clamped down on it and said, no, you don't, and made a one-sided adjustment. And then Chevron had effectively lost that money to tax if you've been too clever by half, and they couldn't claim it back in the US. But thin capitalization effectively works at, like, could an intercompany relationship be substantiated as if it was between third parties? So if I go out and borrow a certain quantum at a certain rate of interest, would I be able to do that if I was doing that off the street and from a bank, etc., as opposed to a related party? And if there's excessive interest that's being charged, then it's disallowed for corporation taxes. So these have real kind of impacts on firms, and most firms aren't necessarily aware of it. Just a bit about the broader context of transfer pricing. In the bad old days, probably 30 before 2010, 2015, transfer pricing was very much seen as a tool to manipulate profit outcomes. And fortunately for people like myself and Simon, who are on the right side of taxation, as it were, the rules tightened up very, very much. And in 2015, the base erosion profit shifting project came into focus. And that's where you had your country by country reporting, where you have to say what you're doing in each country, your local files, your master files, which have been implemented slowly across the globe. And more latterly, you've probably all heard of Pillar 1 and Pillar 2 projects, but not necessarily paid that much attention to it, which I do understand given there's been so much back and forth. But Pillar 1 is a set of proposals whereby it's effectively, once you've deducted certain amounts, the remaining revenue should be allocate on where sales are made. It's very much targeted at the digital economy. It's not going to hit, I would imagine, any of your clients unless you deal with Amazon and Facebook. But effectively, it's global revenue over 20 billion euros. And then a de facto sales tax comes into effect. And then we have Pillar 2, which is to do with the global minimum tax rate to avoid profit shifting. So, and this is again for companies over 750 million euros globally. And it's, if they're not paying at least 15% tax globally, then there should be an adjustment. If it's a UK-headed company, that will be in the UK, etc. But this is still a bit up in the air, because although the UK and many EU countries have signed up to it, it's the US hasn't committed fully to either Pillar 1 or Pillar 2. So they're both TBD. But as I say, they're quite opaque, and although they grab the headlines, they're generally not something that's perhaps necessarily that important for the day-to-day thinking and running of most companies. And so we've really had in transfer pricing, notwithstanding the BEPS project, which, apart from dealing with some of the bad practices of the past, also looked to address the digital economy, as we just alluded to. But we've really had a changing landscape in transfer pricing. it's telling that in many companies, transfer pricing has shifted from a part of tax planning to compliance. That it's very much seen as something we have to do and have to do right. So planning your transfer pricing is more important than ever. You have to get it up front right. You can't go back and say, actually, we should have done this, because it just won't be accepted. And the worst case scenario you can find yourself in is where you actually should have done something different, and one tax authority says so, but the UK or another one says no, you don't, because you're into all sorts of processes to try and get adjustments. Another thing that's changed the landscape for transfer pricing is Brexit. So many UK firms could just sell across Europe because it was one market, and now they're finding that their supply chains have been completely disrupted, and entity functionalities have had to change. So a good example is we have a client who's an SME, and they've been selling models, almost dinky toys, as it were, of the royals of all things, across Europe. And a big market for them was Germany. Obviously, Her Late Majesty's Visage is more popular than the Kaiser's, but they effectively couldn't sell anymore. So what they had to do was set up a German firm. And then they thought, well, how should we do this? And we said, well, you can actually have a branch that's something called a limited risk distributor, which is minimal kerfuffle, but it gives you access to the German market. So Brexit has led to a real rethink of transfer pricing and a real rethink of supply chains, business restructuring de facto. So what does good transfer pricing compliance look like? Is that you're here again, substance over form. It's the reality of what the functions, functions, who's doing what, where, what assets are being used, and what risks are being borne. It's not anything cosmetic. You can't have a situation where you've got IP, say your intellectual property housed in the Isle of Man, and there's nobody there. If you want to do that, what you need to do is have an army of people there, or key decision makers there. It really has to reflect the economic substance. And or the transfer pricing should always reflect the latest transfer pricing guidance. Transfer pricing aligns to the OECD. It wouldn't work otherwise. So effectively, Germany, the UK, every economy in the world, Brazil was slightly off piece, but it's now itself under pressure, signed up to the OECD. And because if they're not literally applying the same rules, then it's not going to work. So that means the transfer pricing advisors, such as Simon or myself or the rest of the team, they can give advice which not only works legally from a UK point of view, but also will comply with local legislation in Brazil, as an example now. So obviously we talked about intercompany service agreements needing to exist because it substantiates that this is signed by directors of respective companies as if it was between a third party. But really, I think having something on file so that HMRC, and when they request it, you can hand it over, is absolutely imperative. So you have 30 days typically, although if you ask them nicely, they might give you a 30-day extension to say what you're doing. But there is, from HMRC, a very proportionate risk-based approach. They're a saying I always use, which I'm not sure how well it goes down, is you don't need an elephant gun to sort a fly. So it's that they do understand the admin costs, and the emphasis HMRC always use is on reasonable efforts. So basically, you're not taking the proverbial. You're really actually trying to do the right thing based on the information available and proportionately. So again, into proportionality, we'll go through a slight SME life cycle earlier, but as we say, it should reflect proportionality. So I think an SME, when it sets up, should think about transfer pricing even before it starts having a legal entity overseas, even when it's just thinking of selling, because the big question is, how are we going to do this in the long run? Where are you going to house your intellectual property? But this, as I say, this can be done very, very proportionate. It can be a chat with an advisor who will just say, look, this is what you need to think about. These are the things you should be considering. And this is when you need to think about the next stage. So we had a US firm that set up in the UK recently. It wasn't really sure what it was going to do with the UK company. So we gave them a placeholder piece of advice, a short email saying, until that decision is made, this policy should be advised. And rather than your £50,000 monolithic transfer pricing report, it was just a £500 piece of advice that they could stand behind. And when HMRC challenged them on what they were doing, they handed that over. And thank you very much. We've taken independent advice, behave responsibly, etc. But what we like to do is grow transfer pricing as it goes along. We like to grow with our clients. So an email can suddenly turn into a longer note, which suddenly becomes a transfer pricing memorandum, as we call them. So I'll just talk about our approach. We've got a fairly large and growing team. I think there's about 15 of us at the last count. And it's quite nice because everyone's from a bit of a mixed background. So, for instance, just taking Ana Reyes, is a Colombian tax lawyer. So we've got a mix of lawyers in our team. Lots of transfer pricing people, maybe a third, come from a legal background. Then there's dyed-in-the-wool management accountants like myself and people like Simon from the tax authorities. But it's also an international team where, because you can practice transfer pricing internationally, you often find practitioners are global and have certainly got a different outlook, which is helpful. So that's our team, as it were. So our approach is very much pragmatic. We want to think about things. We don't want it to be theoretical, where you're just told, okay, fine, go off and do this. Because of my personal background in-house, I very much focus on how does it work in actuality. So we have a very pragmatic approach, but we also like to consider broader international and indirect tax issues, because if you're, for instance, having an intercompany agreement, there might be VAT issues and there might be withholding tax issues, all of which need consideration. And we also like to help out when it's very difficult to justify a past you haven't written. But we often have clients who have got policies in place which are then being challenged, and we'll often help them substantiate that, but also move forward to a new policy which we feel is a bit more effective. So our advice, pound for pound, I think is really high quality, and I've seen enough and worked enough as a client myself with enough bad advisors to know when it's not. So as well as analysis and review, we look at and writing actual reports and documents. We also provide something called benchmarking, which is when you reach a certain size and HMRC likes you to substantiate what you're doing by looking at third-party comparables. It's effectively what the price of the same service by a third party would be charged at, and we provide that. We provide dispute resolution as well, as I alluded to. There's been a lot of disputes following COVID-19. Some of those have been about permanent establishments, where good example is lots of people went home to their country of origin and left London for a while, and then perhaps stayed a bit too long for HMRC's palette, and then they were saying, well, you've got an effective business presence in Spain or what have you, and we obviously defend those positions, as well as giving sound advice about how, either if you want to carry on working that way, you need to incorporate a company in a certain manner, and it can be done very simply like this with a very simple transfer pricing model, or equally turning around and saying, well, here's the first ticket back to London, as it were. So we're very happy to work on things like that. So we work on diverted profit tax, the profit diversion facility, etc. But our approach is really the reason I like transfer pricing, my colleagues say the same thing, is that there's nowhere to hide. You have to get under the economics of a business. And as well as a third of practitioners being from law, you often find a third economists as well. So our approach for SMEs is that when a firm sets up, and this is again what leads us to work with Ignition and partner with them, we just have a freebie call, and we just say, look, this is what you need to think about. Where's your intellectual property going to be? What are your target markets? How are you going to get your money back? And we very much deal with SMEs as long-term partners and friends. I particularly enjoy it because they're entrepreneurs, they're really good people, they're good fun people to work with. And then when action's finally required, we'll onboard them as a client. But what we do is we see it very much as a long-term. I know it's a cliche, but it really is true in our case, that we see them as a long-term friend and partner. So we'd rather than oversell, we'd rather say, this is what you need now. Where are you going to be in a certain amount of time? If you don't know, that we think about it at that point in time. But we very much see ourselves as almost an external part of their internal team. So really, I guess before we go to the questions, with transfer pricing, as Simon very clearly explained, it's a transfer in value between different legal entities, which needs to be priced as if it's independent. So it really is a transfer price. So that's the what. The why is really because it matters for corporation tax and it matters for compliance and part of good governance, and you will financially be caught out if you don't apply it. And the how is, I would say, sensibly and proportionately. Yes, there's certain things you need to think about, but you to use to paraphrase somebody, you don't need an elephant gun to swat a fly. So when a firm is starting out, it can do things proportionately, but the most important thing to do is to actually do something and have some policy in place at the time and not do it retrospectively, or else you're going to end up with one side adjustment. So with that, I'll stop sharing my screen and we can see if there's any questions anybody would like to ask.
Yeah, Phil, I did just want to add as well in terms of where you guys can assist as lawyers and having a legal background. It's when these, we're there to advise clients with the policies and, putting the policies in place. But all of these policies do require separate legal agreements that do underwrite them. And that's where we have a close relationship with lawyers within our office that actually will write up the agreements for us, because that's obviously something that we can't do. So I think that's just another value add with the collaboration between the law and TP as well. Sorry, Phil, just wanted to add that.
Yeah, no, that's a really good point. And the other point, Simon, I think George also made it that is that it often comes up in due diligence for lawyers. But we also find that a lot of our clients, they need business restructuring, so that they come across and say, okay, we need to change our business completely. What do we need to think about? And again, that's from the legal point of view, that's why we partner very closely with legal firms and say, fine, we can do the transfer pricing, but in terms of setting up new companies, thinking about things from a broader point of view, that's often where our partnerships with legal firms come in, and it's a really good one, because there are certain things we don't do. I mean, we love to call ourselves subject matter experts. I sometimes call us sort of rather snidely one-trick ponies with transfer pricing, but certainly it's something where we partner very, very heavily with legal firms. So with that, are there any questions?
I suppose a great question for me, Philip, would be, not that I am an expert in this area at all, know a huge amount about it, but I think it's been really interesting. Are you seeing more SMEs coming to you at the start of their journeys to have this conversation, get the relevant advice, or is it still a case that the majority of them are coming to you later on their journeys when there are more complexities and issues to deal with? What are you seeing from your perspective?
Yeah, there's definitely been a shift. I mean, I think there's a realization that but it's generally when they hit the M spot, and they should be thinking about it when they hit the S spot. So I'd say that, maybe 2 or 3 years ago, about 90% of SMEs didn't have that initial conversation. But now I think about maybe 30-40% of them are having that initial conversation. So there's a higher realization that they need to do something about it, and they will and I think part of that's also that we try and flag it to them, and we do things like this to try and, with good friends like yourself, to try and bang the drum early on. But it's really, the thing is, you don't know what you don't know when you start out on that journey, and I think that's why it's really important for us all, as people who care about SMEs, to bang that drum early on and say, what are your thoughts on it? And typically the most common question will be, what the hell is transfer pricing, which which I'm still trying to explain to my children, but there is an increased awareness, and I think it's normally because of war stories, where SMEs obviously operate within networks themselves, and they say where people have got caught out. So they say, well, a colleague or friend of mine, associates, got caught out by this. What do I need to do? But it's definitely an increase.
Okay. Good to know. Thank you.
I'm quite curious to know what the most common kind of pitfall is. What's the most common mistake that you see?
I think a lot of it is guesswork, that people have heard of a certain amount of transfer pricing and they say, oh, we'll just put it on a cost plus X. And from I suppose also from an inbound point of view, the most common pitfall we see is that I think UK advisors and lawyers are very, very good and look at things from both perspectives, whereas I hope I'm not offending any listeners here, but you get some US advisors who are very much focused on managing their own risk. And the other thing that I think is a pitfall is when a client is given advice, which is you can choose any number between X and Y. It's supported by this analysis. And I always say, well, we're here to give specific not coordinates, not a broad field, as it were. So then it's just leaving it down to people's guesswork. So it really is when people have heard of it's a cliche. A little knowledge is a dangerous thing. That you can fall into pitfalls there, and it doesn't take much to actually get it right. It takes very, very little. I mean, if people like Simon and I can't bottom things out for SMEs very, very quickly, and then we shouldn't be doing this job, to be frank. But it's when people guess.
Yeah, I think on that field as well, it's having the support for the policies. So it's hearing something, putting the policy in place, but not actually doing the DD around why it's in place, why that number's been there, and having the support for that, because that's the biggest thing for tax authorities. It's okay, you have this, but why? That's the biggest thing. So that support's key.
Thank you.
There speaks an ex-tax authority, man. There any other questions at all? If anybody does have any questions offline, please feel free to contact Simon and I directly, and we'll either give you a call or email you back. But you appreciate you might want to digest. It's been a lot of information this morning, but if there aren't any other questions, I'll hand back to Tammy.
Thank you both, Philip and Simon. We will circulate the slides and your details, so if anyone has got those additional questions, they can let you know.
Yeah, I'll send you a slightly updated version of the slides. As Simon and I spotted one or two hilarious typos. The global laxation regime sounds more like a medical cure than anything else. But we'll send you the updated version.
Okay, great. Thank you both. And yeah, thanks everyone for coming along. The next session, as I mentioned earlier, I think it's the 19th of November, on share options and growth shares. So maybe see some of you there.